Election night in America is over. The midterm elections are finished, and I just posted a poll to my community asking, do you think US stocks perform better or worse after midterm elections? Now, I just posted this an hour ago, but so far, 41% of people think that it does better, and 26% thinks that it will do worse. And 33% are not sure, they just want to see the results. So basically what I wanted to talk about in this video is why you shouldn't care about politics when you're investing, because it's gonna really disappoint you. I'm gonna go through some of the returns that you could have expected after midterm elections. But first off, I want to tell a story. This all goes back to the year 2008. I'm 6 months out of college and I'm a financial advisor. 6 months out of college, I'm a financial advisor. Like, I'm going and I'm talking to people about investing their money. And what do I know, right? So it's 2008. Do you know what's going on in 2008? In September, we have the fall of Lehman Brothers, so obviously not a good time to be a financial advisor. The first week of October, we have the 2008 financial crisis bailout package. Bear Stearns, $30 billion, $831 billion in tax cuts, Harp Bank bailout, $440 billion, Fannie and Freddie bailout, $187 billion. Things were really bad, and we had a presidential election coming up. Now, at the time, I'm a new financial advisor. What am I doing? I'm cold calling people. I'm sitting in my office and I'm just picking the phone up and I'm calling people. And who do I call? Well, pharmacists are the easiest people to get a hold of because there's no wall between them, right? They answer the phone at the pharmacy that they work at. You call the local supermarket, you call your drugstore, and you get a hold of the pharmacist. So I'm cold calling pharmacists and I get a few on the phone and I go to meet this woman. Now, this meeting stands out to me because I always think about it around election time periods because it always instilled in me the understanding that you shouldn't care about politics when you're investing. Basically, during the meeting, the pharmacist tells me that she doesn't want to invest in the stock market until she sees the results of the presidential election. Now, I understand that the market is tanking and no one wants to invest at that time period. I get it. But going with the political party that wins the election, it's not going to do anything. I know a lot of you watching this, you probably don't think and agree with me about that, but it really doesn't matter. It matters for so many things in the country, I understand that, but it doesn't matter about the stock market. And one day you're going to realize this, that you shouldn't invest based on your political beliefs. Democrat wins, Republican wins, who takes control of the House or the Senate, who cares? I mean, I care who does because I care about the policies that they make and things like that. I don't care in terms of what I invest inside the stock market. To me, that's not going to affect my long-term results and what those end up being. And I'm going to tell you right now, this woman, when I called her back after Obama won, she said that she's not investing in the stock market. She's done. She doesn't trust Barack Obama, and she's not going to invest. So I met with this pharmacist back in early October of 2008, right? So let's go to 2009, the following year. How much was the market up from that point? It's up 20%. So she decides that she doesn't want to invest in the stock market because she wants to see what happens with the presidential election. She doesn't like the results. I call her, I'm talking to her in November now, and she still doesn't like the results. Well, if she had invested back in October when I had talked to her, she would have been probably up at least 20%, assuming that we put her in the right thing, right? So who knows if that would have happened. But if we just invested in the general market, the S&P 500, she's up 20%. And she's up even more if she had decided to invest after the election. I called this woman about a year later, and you know what? She told me the same exact thing. So I know that probably for a year, she wasn't investing. So you get that. So how much do you think she would have missed out if she just didn't invest during any of the Obama years? If we look at November 2008 till November of 2016, and we say, what is the return of the general S&P 500 index? You're looking at 193%. She would have missed out on 193% return by just not investing because she doesn't like the president of the United States, right? It doesn't make any sense. Let's say instead she goes ahead and says when Trump is finally elected that she's going to be happy about that, and so she invests during that time. So if instead she waits for Trump to be elected in November of 2016 and she holds her money in the market until 2020, well, okay, we're looking at 31% gain for this woman. So great, she got some money finally. But if she sold there because she didn't like Biden, well, she's looking at 8% right now, and who knows what's going to happen going forward, and I don't know what's going to happen with inflation and rising interest rate environment and stuff like that. All I know is you shouldn't care about politics when you go and invest in the stock market. Okay, what do you think that the returns have been after midterm elections? Take a look at this New York Times article. The market usually rises after the midterms. Will this time be different? Now, I took a few highlighted parts of this article here for you. So the months leading up to the midterm elections have generally been the worst in what is known as the 4-year presidential election cycle. But the stock market is about to enter a sweet spot. Stocks have usually rallied in the years after the midterms, no matter what side wins. It doesn't matter who wins the elections. So we can see this a little bit later in the article. It says the market has generally flagged in the months before the midterms and prospered after them. And then over here we have Ned Davis research, goes back from 1948 until 2021. And it says this S&P 500 for year one in that presidential election, right? It's a 12.9% return. Year two, that's the year that the midterms happen. There's a 6.2% return, okay? Year three, 16.7, year four, 7.3. So the best time to be investing is that year leading up until the presidential election, right? Or the year before the year leading up to the presidential election, the third year in the presidential cycle. Now, the thing with what we were just looking at, it's not misleading, I would say, but it's basically just saying that this is a 1-year period, basically annualizing it, right? So if you look at January until December, what's happening annually, right? So we don't want annually. Let's take a look at what happens year over year, right? So in November, after elections, after the midterms, what's generally going to be expected? Here we have Silverlight Asset Management, LLC. It says midterm election cycle. Since 1950, there have been 18 midterm election cycles. And the 12 months following each of these cycles, the stock market has had positive returns. So if we go all the way down to 1950, we can see all the different returns going up 1 year after this thing. Every single time period has been positive. Now, there is a question, is this time different? That New York Times article said that. It asked that question, is this time different? And we don't know. Who knows if this time's going to be different? But we do know, looking at history, that right now is actually kind of a really amazing time to be investing after a midterm election. The average 1-year total return after an election, midterm election, is 18.6%. Now you're probably asking yourself, oh, well, is that better than other years? Yeah, it actually is. The other years, 10.6%. So it is a much better time to historically be investing right now, right after a midterm election, which may seem counterintuitive if the party that you're voting for didn't win or didn't take control of the House or the Senate or whatever it is that you wanted to happen. If it didn't happen, don't invest based on what just happened, basically, is all I'm trying to tell you. Now, we can also look at different time periods going forward, right? So let's say instead of just 12 months after the election, 6 months forward, 16.1% return. So we're looking at a potential average return over the next 6 months of 16.1%. People, that's obviously a great return in 6 months. And then in 24 months going forward, 33.7%. So you can't sit there and say that it's a terrible time to be investing because you think that you don't like what happened with the election, unless there's other things that really are driving you to not wanting to invest. Maybe it is inflation, and maybe it's the idea that interest rates are going to continue to rise. Whatever it is, that's fine. If it's about your political ideology, I'm telling you, you're going to be very disappointed investing in the stock market for the rest of your life. If you keep doing that, it's not going to work out for you. The last thing I want to show you, and I think this is an important chart because it's going to show you the intra-year lows, basically, that have happened during midterm elections. Now, I got this from Mike Zaccardi, and he actually got this from Ryan Dietrich. And so this says, midterm years don't usually bottom until later in the year. The S&P 500 index pullbacks during a midterm year, and then these are all the different years of the midterms, right? These are the intra-year low. So the low of that year of the midterm year, right? So midterm year of 1950, the date of the low was at July 17th of 1950, and that low that market that year, it went down to negative 14%, and it ended the year a year later at 30.9%. Let's take a look more recently at 2010, right? Back like I was saying with that pharmacist, right? That pharmacist, she may have been saying in 2010, in July of 2010, she's saying, okay, oh, the market's down 16% so far this year. I'm smart. I didn't invest because that is the reason. But look, 1 year later, 12 months later, it's up 31%. And as I showed you in that chart before, she missed out on like 190 something percent potential return if she had just invested in the market during that time period, right? And so the average date of the lows is actually August 14th. That's kind of interesting. So the average date of a midterm low, That's the date of the average low. The median date of the low is September 4th. So the intra-year pullback on average is down 17.1%, and it ends a year later at 32% up. Again, all I'm saying is whatever happened in this midterm, if you're happy about it, if you're not happy about it, sweep it under the rug. When it comes to investing, just sweep it under the rug. Think about long-term investing. Think about growing your money over the long term if you're a long-term investor and if you're young enough to have time on your side. Now, if you're that person, I say you shouldn't really care. I hope you liked this video. Bit different, more relevant, and if you did, like and subscribe, please. And got a disclaimer here. Affiliate links below. Support the channel, please, and see you next time.